So why do alternative investments belong in your portfolio? That's the question we're going to answer today. And I'm going to show you what Ankerstar Wealth is doing to get more of these alternative investments available to you for your consideration. And should you choose to invest in them, get you invested through all the paperwork and stuff, because it's a little bit different than your regular type of investing. I'm Steve Ankerstar. Thank you so much for listening in this morning's financial education presentation. Do your own due diligence before acting upon anything you hear in this presentation. More disclaimer information is available at anchorstarwealth.com, and the opinions expressed are mine and mine alone. So let's start with the why. Why do you want to invest in alternative investments? Well, it's investing like the professionals invest. So get this adjusted here a little bit. So here you have our team that's focused on the family office light, right? So when you think alternative investments, think family offices, think institutions, think endowments, along those lines, right? So we're trying to bring that to everyone that qualifies. And for these things, you do have to be an accredited investor, not for all of them, but for some of them. But certainly you want to know that they're out there. So it's an education piece first. And then if you can get in on them, then we help you with what's the right amount to invest in it, and kind of the how as far as the paperwork and what you can expect as far as liquidity. We mentioned the word, so there's what we're trying to do. And as we move up market, meaning the average client base is a higher and higher along the net worth spectrum, or as you grow your investments higher and higher, then that's what we're trying to make these offerings available to you. When I say accredited investor, let's talk about qualifications first. Here's your definition. I'll highlight it for you. This is again SEC. So you can make it by income or net worth. So your income, if you're single, 200,000 a year for past couple years. So nice, healthy income. Congrats if you have that. But if you do, that will qualify you. Or if you're married, then it's 300,000 combined between the two of you. Or you can make it simply by having $1 million investable. That does not, it does exclude your primary residence. So the million does not count your house, which again is the way a lot of people build wealth. Or you can be in the industry is what the other ways are. If you happen to have a financial license, you're automatically brought in. So the reason I bring it up today is because tonight we do have a client appreciation event, Worth Investment Group's coming in. That's not a name that I would say is a household name like many of the others are that we're going to talk about today. But I did learn about these folks a couple months back. Had a meeting with one of their individuals who lives here in the North Austin area. I was very impressed by her and talked to the CEO over a Zoom call at that time. And they eat their own cooking, which is one thing in the alternative investment world is, when the CEO says, I have, millions of my own money behind this, that's always good to hear. They have a private equity offering kind of at the middle market space. I'm not going to go into that here. I will let you come out to the actual event. We also, it's being sponsored by them, and Gracia Mediterranean is a new food sponsor, food caterer we have not used before. So pretty excited about that too. Change up the food lineup for those that are coming out quite a bit. But when you think of alternative investments like the Worth Investment Group, here's what we've put together. It's a menu, if you will, of the things that Ankerstar Wealth has approved. So why do I highlight that? So it's important when you hop into, you may get called on these already. Certainly, if people know you're rich, they're going to start hitting you up directly on this stuff. At that point, you have to do all your own due diligence, and if you invest on it and get scammed or take your money, that is 100% on you. Okay, so that's not meant to scare you. That's just meant to be realize if somebody finds you out of the clear blue and pitches you to send them a whole bunch of money on a bunch of promises that you need to do your own due diligence is what we're doing for you. Now, I bet I have been pitched probably over 200 private investment opportunities. So I get hit with these a lot. I used to listen to every single one, partly because I needed to educate myself. And secondly, I need to be somewhat familiar with what's out there. More so than what I would say the line advisor, right? At the CEO level, you need to kind of know who the players are in the industry and stuff. So I've done, several years of education on this, and that's why we're really just kind of rolling this out now. We've rolled it out to a few of you as individual investors, but really not to the whole Ankerstar Wealth. We're almost at 300 households now. So, really been making sure that we get this right. So one of the things that, one of the value adds that we have for you, which is not ever really something you can really put a number on as far as a value, is that we do our due diligence on this stuff. We we take this seriously. You don't end up on this menu unless we believe in your investment. So let's kind of talk about these. Well, let's talk about why they belong in your portfolio, right? Because that was the original question. So we'll pause while this screen is up and answer that very question. So the stock market is amazing. It's the best form of wealth creation out there. Anybody can start that's got whatever the minimum is at $50 or $5 or whatever it is. Anybody can start, anybody can move up or attempt to move up the, financial wealth ladder, if you will. Um, their companies, they're all public investments, are very well vetted. That doesn't mean they don't go down. But they have strict listing requirements that they all have to meet just to get on an exchange. If you're off in the pink sheets, that's on you. But for the most part, things that you're into with your IRAs or with your 401ks or thrift savings plan are all highly vetted, a lot of eyeballs on. You're not getting scammed with anything that's really in the public markets, for the most part. On occasion, something slips through. But certainly the downside and the good news is it's liquid, right? Maybe not in your IRA or your 401k, but if you have a taxable brokerage account, you can take money in and out. You can invest, you can trade if you want, swing trade, day trade, run all kinds of options, whatever you kind of want to do. That's all public market stuff. The good side is it's liquid. The downside is it's volatile, which you may like, you may not like. As a long-term market investor, I like the volatility. Volatility equals opportunity. And every time the market goes down and everybody starts selling, I'm buying. And it's like magic, but it's not for everybody. And if it makes you nauseous for your $400,000 account to reset down to 300,000 on a 25% sell-off that can happen in days, then yeah, you might say, you know what, I don't like that. So why do endowments and pensions and things like, institutions not like all of that market exposure? Well, they do like market exposure, but just to a certain extent. They really prefer reduced volatility because if they're having to pay out a pension or a foundation that is donating so much money a year to charity for as an example, they need more stability in that market. They can't have this whipsaw roller coaster act going on when they're up in the hundreds of millions level or billions level of assets under management. It just is not good for them. So they do the reduced volatility, but they also generally will get higher returns. Now, this is where you have to really be specific. Are you going to beat like the path NVIDIA or Apple or Bitcoin has had? No. But those are individual stocks. When you think of market as a whole, or the S&P 500, which is commonly referred to as the market, yeah, 10 to 12% a year, but it's not a straight line. You can often private investments often get up into the low teens on a regular kind of, printing money kind of basis. There's additional risks there and things are illiquid. If you aren't familiar with the term illiquid, then you have a lot of learning to do before you get into these types of investments. But illiquid roughly means you cannot sell it when you want. Or if you do sell it early, then you're going to have some form of penalty, generally in a percent or two, by taking your money out early. So why is that the case? Well, the super professionals, which are on this slide, they raise capital and then they allocate that capital, but they also know that the consumer is not just going to rug pull their capital back out overnight, right? Because that's a problem. You can't get into building a huge, like Buchanan Capital Partners. They do real estate, multifamily home often is the you can't just have capital flowing back out that just showed up. You can't stop building the multifamily complex because somebody changed their mind. So, like Blackstone, largest private equity firm in the world, that's a fact. My opinion is that they are the best consummate professionals. They know more than you. They know more than me. They always will know more than me. They're the smartest out there. And they make really good money because they do significant diligence on things out there. And they have two funds that we use. So, when you think of it, it's truly investing with the best of the best lifetime pros. So that's kind of the why it belongs in your portfolio. is really to reduce that volatility and then seek out some extra returns. Some of this is focused on income generation, some of it's focused on total return. So I'll transition back to this chart. The top four are kind of income generation that I talked about. You have Blackstone. I've been with Blackstone for, I think, 8 or 9 years now, both personal money and client money. And they have the two funds, a real estate and a private credit fund. Private credit is a fancy way of saying loans. They loan to, there is a level that if you walk into your local bank, as the example I use, and want to borrow $1 million, they can loan you $1 million if you have the right, right business plan and right financials. But if you want to borrow 10 million, your bank might go, no, that's above us. Well, it's a problem when you go above the bank level, right? Because when the banks are going, oh, we just don't want to give out that amount of money, that's when private equity, there's a huge space above that that people want bigger loans, and that's where private equity can vet you and then choose to make that loan or not. And often, if they make it, they're making it at the 10, 12, 14% level. And if you need that much money, then you're going to pay that, right? That's just how it works. So those are the two Blackstone offerings. If you're interested, they got pretty low mins. Let me reach out. Walton, I love this. It's a land-based deal for D.R. Horton. They go out and much like Southwest Airlines hedges futures for fuel out 30 years, basically, Walton buys land through in conjunction with talking with D.R. Horton on where they're going to build houses, but they go out and buy all the land for D.R. Horton, and lock it in now. And D.R. Horton, roughly, my rough explanation is pays them about 15% for holding that land for them. And then the 12% flows down to you. So about 1% a month on your money is roughly how you can explain that. What can go wrong? Well, if D.R. Horton doesn't build in that area, well, then Walton simply sells it to Lennar or another home builder, right? So it's, D.R. Horton maintains that first right of refusal, if you will. So as long as things are going good, then no problemo. After that, then Walton does have some outs. Ankerado is folks again. I've been vetting for the past few months. They have several different offerings. There's a couple that really interest us. So you'd have to get in touch with myself or one of the team to learn more about that. But income generation around that 10, 11% through several methodologies within structured note world. So, but they're like, I know at least somebody listening to this said, haha, Steve, you said structured notes years ago is financial engineering. Mm-hmm. Yeah, I'll stand by that. It is, but there's times when financial engineering can work for you. And I like the way they do their business to be able to get the most out of your capital to generate that income. So if you want to learn more, then reach out. Buchanan is real estate. He's local here. He's come out and spoken at the in-game lounge. First class, he pays you basically your returns before he pays anybody on his team. It's a 3-year holding period. You're going to get 50% return of capital roughly. So put 100,000 in, you get 150 back out. Pretty good deal. Moonshots is our local venture capital firm. Both founders used to be here in Austin. One has since moved to Florida. That's Kelly Purdue and Craig Cummings. Kelly was the winner of season 2 of The Apprentice. If you know that name, they're both West Point grads. They're first class. They are fantastic in the VC space, and I consider myself privileged to be an investor with them. And we have a handful of us that are invested with them. Worth Investments, again, that middle market private equity. We're buying entire companies and holding them, and then either getting them bought out is generally the path. You're going to hear more about that tonight. And then the bottom 3 are individual investments in private companies. Invested in all 3 myself. Obviously, Ankerstar Wealth is Ankerstar Wealth. So, do your own due diligence right there, because obviously I'm conflicted as a CEO. I'm going to tell you it's a fantastic investment, but we've been growing 30 to 50% a year. Medcana is pharmaceutical. Marijuana. So if you hear marijuana and you're like, I'm out, then be out. Don't invest. But it's pharmaceutical grade. It is grown in Colombia. So if you hear Colombia and you're like, I'm out, well then be out. But it's one of our clients is the CEO of that and is hitting home runs. We have a due diligence event coming up on 6 October also combined with a tequila tasting. So come on out and hear more if you're interested in knowing what the latest is happening inside the Medcana space. And then lastly, Advisor Stack there on the left, that is our tech stack. So they've helped us with the Black Diamond to Adapar transition. They're helping us with using Stratify and Riskalyzed, which is now nitrogen, to be able to, maintain proper risk controls on your investments. So basically what they do for me is they're my outsourced CTO. They're my chief technology officer as a firm. So instead of myself or Candace or Corey or Jaden or somebody here in the home office having to spend all that time trying to figure out how to get the tech talking to each other, which is all tech is pretty good, right? Otherwise it wouldn't be here. It's getting it to talk and report the correct things is the hard part. So that's what they do for us. Also an investor with Advisor Stack, and several of us are here on the team. Okay. A presentation that's coming. It's not for today. Corey's working on this. Thank you, Corey, for the hard work. But in addition to that one pager, which is now kind of an insert into our pamphlets, we talk to folks. It's like, here's our normal offering. And then if you're interested in alternatives, look at the insert and then we can talk about each of those. He's building out to where you actually have a slide for each of the offerings, right? So here's the first 5 that he's been working on. We'll have this ready to roll in a week or so, but really talking about the specifics, consideration, risks, all that stuff. So the take the due diligence that we've already done and try to answer the questions you're going to have by putting it on a slide, a visual presentation of that liquidity and predictability, expected return, that sort of thing. So you can really have all the information at your fingertips to be able to decide whether or not to invest in one of these things. So again, we'll always give you our opinion, but why not kind of capture that into one single source so we can have it at our fingertips if you have questions. And of course, all these have their own individual websites and things from there. So, all right, that's all I have for you today. Thank you so much for listening in. So again, why do alternatives belong in your portfolio? Well, they belong in your portfolio for some diversification from the market and that reduced volatility and accessibility to some higher, more consistent type returns. So with that, that's all I've got for today. Thank you so much for listening in, and we will talk to you soon.